Hello, everyone, and welcome to the Hardcore Finance Show with Shimon and Alex. Today, we have a very special guest, David Blatt, who's coming to us from the world of real estate and debt. We'll let David do his own intro, but we don't talk about debt too much on the show. And so when we were exchanging emails with David beforehand, I'm pretty excited about today's episode. We always do equities, we always talk gold and Bitcoin and crypto, but never fully dive deep into real estate. So I think David will teach us a thing or two today. What do you think?
Yeah, I'm super excited. We touched on leverage in general, but real estate has very special ways of using leverage. So I'm very excited about today's conversation.
And tax benefits and tax shields and this is going to be good. This is going to be good. So David, welcome. Super excited to have you. Can you tell us a little bit about yourself, your fund, your background?
For sure. Thank you. Thanks for having me. I'm excited, and I'm excited you're excited about debt because it doesn't get a lot of people excited. I'll give you just a quick rundown. I've been in the real estate space for 20 years, and specifically in debt. I ran a distressed debt fund for 10 years. So this was like into and through last recession. So I'm just very, very entrenched and have a thorough understanding of just how the debt markets work through all the trades, particularly within real estate, all the different lender profiles, the capital stack, all of that, just, the machine of all of this. So I did that through 2012 when the market came back, and then I formed my current platform, CapStack Partners, going on, almost 10 years now. Where initially we were working with banks to help them club up on loans, so essentially to, come in, get other lenders to participate with them, in doing the loans, doing the stack, one guy behind the other, pari passu, whatever it was, we would come in and start doing participations, and where we could get our hands on distressed opportunities, we did so. And it got to a point where we were just active enough that I was able to launch our current credit fund, which focuses a lot on the acquisition of performing and non-performing commercial mortgages together. So on a daily, I'm interacting with all sorts of lenders, your typical community banks, your bigger institutional banks, your buttoned up PE type hedge fund, with a debt strategy, your private hard money lender guys out in the middle of the country, just doing some small balance stuff, touching every asset class, every kind of situation, senior position, junior position, what have you. So, that's really where we're focused. So we're getting granular at the deal level, but I'm always thinking about the macro, and how that ends up impacting things, because debt in particular is certainly sensitive to macro drivers, especially, in terms of what's going on these days. And real estate in and of itself is always affected by those things. It's a big, expensive fixed asset. And so you always have to be cognizant about those larger trends economically and what the impact may have.
Yeah, as you were talking, I'm just thinking of topics that are popping up in my head. I don't think we're going to get to them, but I do want to plant a seed in your mind. And Shimon's, we need to talk to David about using debt versus crypto as collateral and the rates. We have a theory about what's going to happen on crypto, but let's get to that in a second. I want to start off easy, softball, macro, so to speak. Maybe it's not such a softball. What the heck is going on with the 10-year? Because we have these, the market this year, the market has been so erratic, and there seems to be one narrative of cyclicals, counter cyclicals, forget tech, no, tech is back, and we have our own views kind of the market. But what's interesting is that regardless of the inflation narrative, it doesn't seem like a 10-year treasury for our audience that's what we're referring to is really reacting, right? Sometimes it's steady when it shouldn't be, and sometimes it jumps when it should be steady. How are you seeing the macro perspective? How are you seeing what's happening with the yield in the 10-year? Do you expect it to come up? And do you expect it to go up gradually, or will there be a like a jump on inflation.
I think that's you're touching on a lot of things in that one comment slash question, right? So generally, when the 10-year Treasury behaves, it's effectively a proxy for, the macro view and larger institutional views on the direction of the economy longer term, right? That's what it's supposed to do. And to your comment, right, it's just not behaving, right? And so if it starts to detach from where things are, where the news or just the reports are pointing to, then how do you then rely on it to be that gauge that it's historically been? And so to that end, I will say, this is like one of these situations where you have to separate the signal from the noise to a large extent, and because it is a macro gauge, it's really hard to be tracking something like that on a day to day. Nobody's actively trading it the way that they would be jumping in and out of equities. And so, you have to then take a look at things and what it's a referential proxy of, and so cost of capital, or inflation in this instance, points to the fact that it's going to trend upwards, right? The fact is that, this concept of the great reopening that happened post COVID, we're not done reopening, right? There's an element of stabilization associated with what this new normal looks like, and the new normal is a lot more expensive. Even if prices come back in on material, on everything else, like, people aren't going to like get their wages whacked. um, that's just not going back in the bottle, period. The end, that's just, it is the new normal, and therefore, that in and of itself is just going to provide support. So all of those things, right, when you take a big step back, right, and zoom out on what that information means, points to the fact that, inevitably you're going to see that trend. Now, is it going to gyrate? Sure, but overall, I don't necessarily look at it on a day to day and say, oh, it means this today, because some news came out, and some institutions decided to bail out on it because they're actively trading on those things. That's not really the tell per se. And because of the just general nature of information flow, and the fact that you do have so many participants in the market right now that you didn't necessarily have influencing that, right? It's just not as stable necessarily when you look at it so close up, like right here, you know? So, it really requires a little level of perspective and say, okay, all right, smoothed out, just turning the volume down. Okay, what's really happening on a macro level? And is this, giving us a signal, or is it just responding to that signal? And that's really how we think about it.
Yeah, that's awesome. I wanted to touch on, to Alex's point, right? We're now in a very unusual time from a monetary policy perspective. Governments all over the world are printing a lot of money, or call it whatever, monetary expansion. So in light of that, what is the investment case for real estate? Because we are hearing a lot of questions from our listeners. You have stocks as an investment, you have real estate as an investment, you have crypto. Everybody kind of understands. You had gold, but we think that pretty much like Bitcoin is eating gold's market cap. But within those three asset classes, people know that they shouldn't hold on to cash. People know that cash is losing value. But what is your investment case specifically for real estate in these macro environments?
Yeah, so I would say that real estate has been talked about for just decades, if not longer, as an inflation hedge, right? And so, how is that typically expressed? It's really just tapping into certain aspects of real estate that will resonate with a lot of other asset classes, right? So there's inherently a scarcity element associated with real estate, right? And we're seeing it most prevalent, let's say, in like industrial, like last mile industrial. Like, we can't get our stuff because we just don't have enough infrastructure in place to house it and, get it to where it needs to go, right? So that's one aspect where you're suddenly seeing the values go up. And it's at such a rate that, you know, just without knowing anything about anything, you know that if you're buying like a well-located piece of industrial real estate, you know, where like Amazon would die to be there, like it's going to outpace any level of inflation you can present me as an investment use case, right? So that's like one aspect. And then, you know, housing is the most common one that's talked about in terms of just, you know, you look at the historical supply demand, you know, there's just not enough, and not enough can come online. And oh, by the way, the stuff that is online is now being directed into rental, which the
Hmm.
single family rental asset class is now taking more to own housing off of the market, creating another supply demand aspect. So, you know, that in turn not only creates a support for value, and we're not even talking about the cost of capital from a mortgage standpoint being as low as it is, you know, but then what you're also doing is you're driving renters into uh, essentially single family and multifamily rental properties,
Hmm.
which is driving the rental rates up, and even those then start to exceed inflation. Commercial rents typically by lease also have things where it's like a number or like the basis of the CPI, right? Index. And so, you know, there's certain elements associated with both the general nature of what real estate is, excuse me, and then the cash flow element of real estate, where even when you're getting that cash, it's going to outpace whatever inflation presents itself, and to some degree is looked it looks to inflation as the catalyst for the increase in its own cash flow. So that's why, you know, people look to real estate, and real estate is thought of as this inflation hedge.
Awesome. And so now one of the kind of worries that people have about real estate as an asset class is that if CPI inflation becomes a big problem, like let's say with if it continues and the government or the governments have a hard time getting it under control, if they raise rates, that could have a very negative impact on real estate. Now, I personally don't think that they can raise rates just because of the amount of debt the governments are holding. But I would love to hear your thoughts on, like, what do you think of the rates? Are they going to go up? Is that priced in the current prices of real estate? Or like if rates go up, will the price crash? Like, what are your thoughts there?
Yeah, so I have a strong answer. So I'm going to separate out real estate from, call it the investment equity perspective, and then from the debt perspective, because it comes up in conversation, you know, on both ends, right? So let me just like split that for you. So as it relates to the investment equity perspective and the impact on value related to owning real estate, the short answer is it is not. You know, at the end of the day, people complain about the fact that rates are going up, and we don't want rates to go up because as a real estate investor, we like cheap money.
Mm-hmm.
You know, it's great. Cheap leverage is great. You know, but I will say this. Um, I have looked at market cycles going back 50 years, and I've looked at the peaks and the troughs of market cycles, and then I've looked at what the interest rates were
Mm-hmm.
in those market cycles to see if there was some correlation or trigger associated with the rate, you know, just going up causing a crash or vice versa. And the short answer is that's not really the metric that drives real estate value in any like acute impactful way. What really drives real estate value, and, you know, could pull it in, you know, or expand it, is capital availability, right? So if you look back at the pre-recession, you know, going back 05, 06, like rates were way higher
Mm-hmm.
than they are today. Like the traditional rate was like around a 5 or 6, you know, and I know debt funds out there in the world that are doing like bridge loans, which are supposed to be the risky, more expensive kind of loans that you put out at 5 or 6,
Wow.
sometimes even cheaper. Okay. So, but you go back, and when the market was as frothy as hell, like going back now, like 15 years ago, right? Apparently the market was still frothy as hell, despite the fact that the rate was like hovering around a 5 or 6 or whatever it was. So clearly that wasn't the issue. So if you think about what was really driving the market then, just using that as just one snapshot of time, right? There was so much money chasing deals and investing in real estate, from your like big short fix and flipper people all the way up into the larger institutions, right? Money flow is just everywhere. That was really the driver. And then when it seized up, that's when real estate took this precipitous drop in value, and it took a long time to come back. In terms of what drove that was the markets reopening, the capital markets reopening.
Do you believe that? So I have a couple follow-ons, but a really quick one. Do you believe the same thing will happen now? At some point, they're going to have to ease the, they're talking about tapering. Then they were talking about tapering. Now they're actually going to start tapering. And then, I don't know. There's two schools of thought, right? There's one that conventional school of thought is that the printing will stop at some point, or at least slow down. I think our school of thought is printing can't stop because, well, they can't raise rates and you need to do something with the money so that it will never fully stop. But let's say the availability of money in the market will precipitously slow down. Let's call it slow down without going deeper. Do you see it affecting real estate in the next 2-3 years?
I don't. I don't, because I think that I don't think that the equity side of the trade is that attuned, or that sensitive to the taper as much as the overall fundamentals that are driving any particular asset class or investment. So I don't. Now the debt side, right? Does it change the considerations? I still don't think that you're going to have any sort of like pullback. And I'll explain why. A lot of it just has to do with the nature of the debt capital markets. Back in the day, you needed to get a loan, you went to the traditional bank. Now, you've got so many outlets to finance you, and particularly you've seen this growth of like these alternative lender debt funds out there with a lot of the like more marquee names, like Blackstone, KKR and such. And then, just other, B team guys out there, behind them, as well as names, of all sizings and specialties and things like that. And what it's done is, if any sort of participant steps out of the marketplace for whatever reason, because maybe their money is tied to tapering, right? Like regulated bank money may be a little more sensitive to it. This money is going to come in and fill the vacuum. And if it's domestic money that's getting impacted because, they're really turning the spigot off, then you've got foreign capital that has all sorts of, programs to fill that gap. Because I mean, and I see this, using specific examples, like I know funds that are putting money out so
Mm-hmm.
cheap, but they're making a massive spread because their capital is foreign, and that foreign capital needs 1%. I mean, and they're getting like hundreds of billions of dollars, like, so it's not, now, so you now have sources of capital that aren't directly affected by US tapering
Yeah.
any longer. So it just, to me, becomes very challenging for that to have an impact on the asset class as much as maybe fundamental drivers associated with, jobs and housing and all the things that matter to
I'm
people.
gonna just jump into it because again, I think we gotta have you back. We need to talk for a couple hours about this. So many elements. But here's one, and I was gonna kind of lead you there, but I don't think we have enough time. I wanna really get there. So there are many reasons. I'll give you kind of half my thesis, half question, right? I think there are many reasons of why people buy real estate, not specifically look at the foreign money coming in. Typically, foreign money comes in that's pretty wealthy money, right? That comes into the US and then they buy real estate in the US. Now, why? I think part of it is to get access to, our markets or our way of life. For example, Eastern European or Russian people come here because, it's good to live in the US and frankly have kids who deal with passports and so on. I think a second one is that, well, you're diversifying now. You have places all over the world. Americans do the same thing. But a third one I think is very interesting, and one that many people don't talk about is capital controls in the country. It's a way to get capital out of a country that has strict capital controls. So you can invest. We won't mention some countries, but there are definitely many countries that buy a bunch of real estate, rent it out, and they convert essentially capex to positive cash flow. And this is a one way of getting money out of the country. Now that crypto, Bitcoin, let's say specifically, is becoming investment grade for the majority of institutional players, and I think we're on the precipice with regulation stepping in and clearing up the regulatory environment before all of this mountain of money from Wall Street comes in. Does real estate still have as much of a use? Because you're at least taking one of the use cases out of maybe getting money out of the country. You don't need to buy real estate anymore. You can buy USB or remember the 12 words of your crypto wallet and just walk out, so to speak. So do you see that as a headwind, like a big macro technological headwind to at least one of the use cases of real estate demand?
I mean, look, if your intention is to kind of create a safe harbor for your capital, your wealth, your liquidity, has U.S. real estate been used as that? 100%. Do I think it goes away because you have a much more viable alternative, say, because less friction and everything else that crypto and Bitcoin offers, which is the opposite of real estate, as this big fat fixed asset that's hard to get in and out of. Yeah, look, I think that'll certainly divert those individuals or investors, right, to something that again is offering up a way to put your money to work, right? You do have to also subscribe to understanding the appreciation trend associated, and obviously have a stomach for volatility at this point. Though I will say, regardless of your view, it starts to smooth out over time because of the introduction of institutions and even regulatory controls that the U.S. is putting in place. I think those are going to create safeguards to some degree and make it a little more boring as an asset, which I think is a welcome thing, frankly. So to that end, now you're actually like taking some of that, like, strong stomach roller coaster aspect out of it while still providing the associated frictionless aspects to it. So I think, to that end, sure, it'll divert, from those that maybe historically did that, but by the same token, it's one of these things where on the one hand, it'll probably divert on one level, and then it'll probably complement because now you're also, going to be able to utilize that, as a means of accessing real
Exactly.
estate.
Buy a bigger house or whatever. Yeah.
Right. But I'm just saying, even from an investment standpoint, the fractionalized interest ownership of what is historically a fixed asset that A, has a massive price tag, and B, you can't get out of as easily, is now going to allow for that because of the layer associated with what crypto's proposition is. I think there's a complementary aspect to it, where they kind of like become symbiotic as a trade, in addition to, okay, I just want to keep my money here as an alternative to that as well. So, to me, both of those aspects are very exciting.
Yeah, that's a fascinating point because like we spoke about capital controls and how people can use real estate to evade them, but you could make the case that not everybody can do it. Like it's still very hard. On the other hand, if you can put your money in crypto and then move it outside of the country, that can allow more people to invest in foreign real estate. So I never thought of that. And fractionalizing it, just in general, removing friction. We really believe that crypto, beyond a store of value, it's also like very valuable as a network, a monetary network that just removes friction from trade. So that's
I
fascinating.
like that. That aspect of it is very exciting to me. It's a
Hmm.
very powerful to that end, right? And I actually think that my view is that it is going to be a massive catalyst of value creation in those assets that historically have just been out of reach because of what they've inherently been by their very nature as an asset, right? You're now just like breaking it down and making it just more accessible. And there's an
Hmm.
efficiency of getting in and out of it as a trade. I mean, to me, that just actually trigger, that signals like, you know, call it inflow of the people, so to speak, because you're just like doing that.
Yeah, no, that's fascinating. So we spoke about the crypto implications to real estate. What do you think about stocks? So I know that traditionally, like in the 70s, for example, they weren't a really good inflation hedge. However, we can look at, for example, tech stocks. They could be a pretty good inflation hedge. So how would you say, let's say somebody has a certain amount of capital, would you recommend them to split it between real estate and stocks? Or would you say that real estate is better than stocks? And if so, why?
So I I'm a big proponent, and this is really what I like about the debt space, right? I like the underlying. I like real estate for what it represents to me in terms of, call it store of value, value appreciation, having a cash flow facet to it. Um, and so I like that. But what I actually don't like is a lot of the things that we touched on. It's the illiquidity associated with it, which is really why I gravitate to the debt part of the stack.
Hmm.
I'm able to be a little more nimble in generating the yield, through our fund on the debt side of the stack with utilizing real estate as the asset class by which we do it. So to that end, I certainly don't sit there saying, oh, real estate's the better trade than stocks. And, just saying that broadly is very difficult in and of itself, right? Because you've had some just massive successes within equities, and then you've had like hyped up busts, and then, everything in between, right? So it's a
Hmm.
little challenging, but I do think that it is something that should exist in individual investors' portfolio. So I believe stock is definitely there. And here's the mandate, right? So when we talk about like, as an inflation hedge, not an inflation hedge, the fact that money was printed at the scale that it was printed, to me, was effectively a directive from the government that we don't want you owning cash.
Hmm.
No matter your like station in life, you put that money to work and do it here, right? We've given
Hmm.
you the markets and the framework and the infrastructure. So don't hold cash, because effectively, if you hold cash, you're going to be penalized. How is that penalty being expressed right now? The erosion of value through inflation, right? But if you put that money into these assets, whether they be stock, get a little exposure to real estate, even crypto, you know, you know that you're going to do far better than if you're just like sitting with it in the bank, watching it lose value by the day because things are becoming more and more expensive.
I want to come back to this one point. You guys are talking, and I'm kind of thinking, which is, by the way, what I love about this pod. We could just, we can go deep and have some very interesting thoughts here. We talked about how, yeah, on one hand, we'll pull some money out of the system. On the other hand, we'll make the system much more liquid. The fact that, and this is what draws you to debt, you said, but there are a lot of people who don't understand or are not comfortable with debt. And that should be a whole separate subject. We should talk about, by the way,
Hmm.
how to get, because I think, once it becomes sophisticated, and it's a shame of our system. It's a little bit of a diatribe for me, that we don't, like, we both have, we were both at Kellogg, the top MBA program, and no one teaches you, even in Kellogg, probably Wharton and some of the other ones, same thing, of how to use debt strategically and how to think about debt as a tool in your toolkit instead of as something to, you know, take out but then pay back and manage instead of use, on your behalf. But the fact that you can create DAOs, decentralized autonomous organizations, fractionalize, and you can create a DAO that says, hey, go bid on these real estate areas, right? And now you can have fractionalized ownership of property. Will create access. I think, David, this is to your point of many more people being able to afford housing. Because look, with the money printing that we have, when we talk about this all the time, consumable goods are increasing, sure, but we don't really notice it. Dollar store today was an article. Dollar store now is moving to $1.25 for most of their things. Okay, yeah, sure, it's a 25% increase for the business. It's a huge EBITDA boost, right? But from a consumer, it's like $1.25. At some points, it's not as noticeable. But being able to fractionalize and open up like housing that's getting further and further away and less affordable for people through crypto, right? Through DAOs, through these governance tokens, that's massive, right? Because you're getting rid of a lot of a lot of the friction in the system, the title, and so on. It's instant title, right? Theoretically, it should be instant transactions, and you can own a fraction of a house, and it's like REIT 2.0 or REIT 3.0 for the everyday investor. And that allows people to actually be much more or much better diversified than ever before, because then you got to go find a REIT in your Fidelity portfolio, and they only give you 10 options or whatever, right? And you got to find, retirement fund 2050 or 2070, whatever the heck it is for the younger generation. I don't know what year they're going to retire.
Never. That's
never. But that's actually a point that at least I haven't fully considered. It'll bring a lot of liquidity and depth. The markets will have a lot more depth. Yeah, I don't know if this is where you were going with that as well, David.
I've been thinking about that as well. I mean, to me, what actually I think is real estate's just a fantastic use case for everything we're talking about, because it's something that everybody understands and recognizes as an asset class, right? And it's also one of those asset classes that has enough zeros, right? It's big enough that you can fractionalize meaningfully, right? So it's not like, this like, you don't go to the dollar store and like fractionalize the dollar item, right? Because it's too, commoditized, right? Real estate is absolutely not commoditized. It's the opposite end of that spectrum, right? So there's enough there in any one asset, let alone a portfolio of assets, where you can start to really think about, how the fractionalization can really work. And I think that, to me, again, just all points to this idea of capital inflow. And then you start to think about stack, right? Right now, securitization is the realm of institutional capital, period, right? But what they're doing is nothing particularly sophisticated. There's just enough dollars there to be able to do it at the scale that suits their entire business model to move the dial, right? But to start stacking, at a smaller level requires smaller investors. But again, like, your optionality at that point really just like, it becomes endless. You can really start to think about that, where those individuals that do want to fractionalize, maybe I feel safer at the top of the stack than I do, even though I like this asset class and I like this exposure, versus just having a piece of a building.
Okay, I have a crazy idea. I have a crazy thought here. So just go with me here, okay? Let's say this happens. Let's say there's regulation that's cleared, and we can all create DAOs, right? Decentralized organizations. This DAO collects a pool of money, goes and buys real estate, and then thousands of people own fractions of different real estate, which is kind of the vision that we're talking about, right? Before I go on, I just want to make sure we're on the same page. Yeah.
Yeah. I'm acquainted
Yeah,
with this.
let's go. So wouldn't it then shift the consumption of real estate completely into people living in essentially completely a rent-driven model, where your exposure to owning real estate, taxes aside, assuming the tax benefits in these DAOs are going to be the same as you own a house and you have the same tax shelters, but with tax benefits. The point is, wouldn't it then shift people's consumption of real estate into an investment thesis that generates cash flow, so that we will all be living in essentially rental units most of us, owned by these DAOs. So my exposure to owning real estate will be through kind of crypto, right? Through these DAOs. But my actual living in a real estate, why would I want to own a house where I can pay rent, save that down payment, invest it, generate cash flow through my DAO, and then just pay my rent as an operating expense?
I mean, I think that that is a very reasonable thesis, and I think it's something that is trending in general. If you look at all the disruptive industries out there, we're effectively replacing, what historically needed to be owned with using what we need, right? I mean, look at the Uber. Uber is replacing cars, like car ownership to a large extent, right? In a lot of cities. I mean, as an analog, but like, of course, I don't disagree with that, and I think what it also does is it actually alleviates, um, you know, call it from a public policy standpoint. The fact is that we don't have enough housing for people to own anyway,
Yeah.
right? So if you're actually going to shift the orientation's shifting to some degree just because people are forced to have to become renters as it stands anyway, right? But now if you're offering them essentially the housing, okay, they've solved for I live somewhere now, right? And now I'm actually monetizing, based on the fact that I've satisfied the basic need to have a place to live. And maybe I even own a fraction of the building that I live in, right? So I am in effect paying myself and I'm seeing the appreciation associated, right? I mean, again, it just goes back to the different permutations associated with all of that, and how the views could change and what this idea of ownership is. I mean, we are trending away from this classic, like, the American dream of like owning your own home, right? It's just, it's no longer viable. And a lot of people are also just checking out because they're just not interested, right? So to offer up a new concept, not even a model, right? It just feels like it's going to materialize that way. And I think also technology is really moving in the direction to meet what is already becoming a view, just on a macro level.
Yeah, definitely. So we touched on some of the technological tailwinds for real estate, but there's also some headwinds. So some of our previous guests mentioned, for example, that the scarcity aspect of real estate, right? So that has been the age-old thing, right? I buy real estate because they don't make more of it, they don't make more land. And especially also you have these network effects in cities where it's like, yeah, if you want a high paying job, you have to be in specific physical locations where there's a network effect. Like I spent 10 years living in Silicon Valley until I just recently moved to DC. But Silicon Valley is a good example of like, VCs would not fund startups if they're not in Silicon Valley. But now because of COVID, on the one hand, and also because of technological things that may not have fully matured, but are on the brink, like self-driving cars. Do you think that those could be some headwinds to real estate as an asset class? Like if people can live anywhere, then specifically the high value places, both commercial and residential, could be disrupted. And also, even if you had to be in an area, maybe I can live like 2.5 hours from the city because like my commute is working time if the car is self-driving. What are your thoughts there?
So I think that I guess the centralized aspect of real estate and certain locations, right, that have just been historically like you have to be there, right? So Silicon Valley, and even New York, if you're thinking about like, call it whatever, the financial markets and things like that. So I don't think the significance of places like that necessarily just go away and there's, call it a decentralization, because there is something to be said for having that area, that centralized area where people can come and, whether I'm not even talking about work, in the workplace, like, I think that that's changing, on a, call it much more just micro level there, but I can touch on that. But just saying, like, in terms of like how, where you live is starting to matter and its impact to real estate. I just think that look at all those places. Those places were just like so super congested, and it's already driving people to other places. But the places that it's driving them to are places that are either up and coming hubs or have already been established as such, and maybe it's just adding on because it can support the infrastructure associated with the scale, right? So it's not like people are going out into the wastelands and
Mm-hmm.
just creating some kind of like Burning Man community. They were like moving from Silicon Valley to Austin, you
Mm-hmm.
know. It's more like that, right? So that element of like the central business
Austin is the
district,
Burning Man of Texas. So let's
I
go.
would say, so that's why they figured out, they got the balance right there. Agreed. Yeah. So there seems to be a migration associated more with drivers of a particular location. So like New York to Miami, where you're seeing a lot of funds, and where a lot of the headlines have been, right? But touching on the fact that you got a guy who's willing to take on that 2.5 hour commute. If he only has to go in 3 days a week, and those 3 days he's actually able to get work done in an autonomous vehicle or some form of public transportation, because we're actually investing in infrastructure in this country again, then to that end, right, doesn't that actually say, okay, well, that just fortifies the location to which you're going to execute the work that you're doing, versus like a decentralization where everybody's everywhere. So I mean, look, it's certainly going to be a mix, and obviously it varies by industry and job, but I think that those hubs don't go away, and therefore the underlying real estate that houses them don't go away. If I had to go in and take a bet, I think that um, a lot of people have written office off because of the fact that the way we're working is absolutely changing in a way that doesn't go back. But I would say that, to me, I look at that more as an opportunity to be buying office in locations that aren't going away,
Hmm.
but again, it's the kind of asset class that you have to have just like you've got to have some runway on your views on those things,
Yeah.
right? Because if you're short term and you're trying to be like opportunistic about it, invest in stocks, invest in crypto, don't invest in real estate. That's not the asset class to be doing that in.
Yeah, yeah. I think it's interesting that we always talk about time horizons, and you're right. Like the thesis needs to play out, and it plays out over many years. And I also when the last thing you said was very it kind of hit home for me, because in any industry, right, through any kind of shock to the system, of which COVID was definitely a shock, you have the weeding out, the dead wood kind of dies out, and the blue chips, the cream rises to the top. And so
Unless the government buys the bonds of the failing companies, but that's a different story.
that's a story for another time for all of our other podcasts. So, like, what are they doing? Why are they picking winners and choosers and losers? No, but it's an interesting point. Like, pristine locations, New York, big hubs, assuming policy stays the same, because we know what's happening in San Francisco, and we both have our views on San Francisco. But assuming policy stays the same, um, the commercial can die out and let's say it's the suburbs, but you're going to want to gravitate towards the center. David, how can you tell us a little bit about? I know we only have a few minutes here with you. How can people find you, find your fund, invest with you? Just give us some shameless plugs, please.
So CapStack Partners is the company name, and capstackpartners.com is the website. But really the easiest way is on my LinkedIn, David Blatt, CapStack CEO. I'm active on my socials.
What
That's always a
about
good way to start up a conversation.
LinkedIn? We'll make sure to link it below. What about Twitter? Other uh,
Yeah, so I do post on Twitter, and I we also post on Facebook. Um, but yeah, that I think that those are all the socials. So
Awesome. And we have one question that we ask all of our guests. We call it the hot tip. So anything you can give our listeners about an interesting book to read, an interesting show to watch or movie, or an interesting activity that you've done that might be interesting for our listeners.
Wow, that is a wide
Very
range
wide, no limits,
things.
whatever could be. We've had some really esoteric Netflix shows recommended by our guests, which are
Deep fried egg rolls. That's my hot tip.
Yeah, so let me think about this, because I can answer all this. I read this great book recently, The Caesar's Palace Coup. And it's actually just about how all of these PE funds basically got into a knockdown drag out all around Caesar's Palace. Just everyone taking positions in. They had a recent bankruptcy a few years back, but it's got all the big players. It kind of has a Big Short feel to it. Apollo, KKR, Oak Tree, every like marquee name, and like how they're all angling, and just like how they structured and really just like figured out how to essentially like maximize the return on their investment, off of this operating business at the underlying. And it's like fascinating because it's so focused on just leveraging just something that is just has nothing to do with how they were really like making their money and just trying to like get one over on each other. So that, I mean, you got to go deep and really like financial markets to appreciate
I
like
love that
how they're
stuff.
navigating
One of my
it.
favorite books was Barbarians at the Gate back when I was in business school. So
Oh, it's like that. It's like that, but like modern times. And so you're just getting a lot more. Think of it as like, the updated, like, just like investment and like finance and bankruptcy strategies, and like which court they're going to go into because that judge is like checked out. So they have like, that little edge. It's so that I would highly recommend that read. If you're like deep and you want to nerd out on that.
Slow it down.
I
Slow it
did it
down. There you
audiobook
go.
style as I was walking around. It's great. So I would certainly recommend that on the reading tip. Uh, yeah, I mean Netflix, I'm all over the place. I just shut my brain down on that, so I don't know if I could like recommend anything there. It's usually just trash that I could just like
no, that's
unplug.
great. That
So
book is a great recommendation, I think, for our viewers.
Yeah, so Caesar's Palace School. We'll link all your information down below. Thank you so much for coming on. I want to just say one last thing is, I really appreciate this conversation, and because everything we talk to real estate people on a micro level, and it's not the same level of thinking. And I want to kind of give you you just say thank you. And I love the way you're thinking about crypto, the whole like the fractionalization of crypto and how it's going to affect real estate. I think people are starting to get there, but you're ahead of the curve from the people we've spoken with. It's still very traditional, the traditional mindset, and so I'd invest my money with you. I love the way you're kind of forefront of
I appreciate that. I appreciate that greatly. You can't have the blinders on. It's just like there's so much cool stuff happening, and to me, I'll just leave you with this. But generally speaking, I am constantly just scanning around and just taking in what's going on in the world, particularly from a financial market standpoint, and like how you know investments are being structured, and I try to borrow and then bring it down to a human scale and say, okay, what can I take from this? How can I fashion this into something that could work, or mirror it in a way that they're doing it in this way or in this industry or at this scale. So in order to do that, you really have to be so open-minded to everything going on out there, whether it be crypto, whether it be institutional like structures and how that all works. But I'm constantly peeking under the hood because there's always something you can take away and then just put that in your toolbox and say, okay, I'll be able to apply this in the way that I'm doing things. So to me, it's just that's what gets me excited every day. And I think it's just an exciting time.
Absolutely. Well, thank you so much for coming. Loved having you. We gotta have you on again.
Yeah, absolutely. Thank you so much, David. This was really fun.
I'd love that. Thanks, guys.